1. Is a recession coming in 2026? Short answer: it's uncertain, possible, but not certain. Economists do not agree on whether a global or U.S. recession will occur in 2026, but risks are elevated compared with the mid-2000s. Some forecasts suggest slowing growth rather than contraction, while others see meaningful downside risks. A. What many experts predict. Growth but risks remain. Major economic forecasters, PwC, Deloitte, expect continuing global growth in 2026, around approximately 2.4 to 2.7% GDP globally, respectable but slower than past years and more fragile due to concentrated drivers like tech investments. Some forecasts see sluggish or subpar growth, which is technically not recession, but closer to stagnation, a condition that often precedes downturns. B. Probability indicators. Some banks and surveys put the probability of a recession in 2026 at about approximately 30 to 40%. Bankers' surveys show over half of respondents expect either a U.S. or global recession in late 2026. See current positive data. However, other indicators suggest that whether or not a recession occurs, the economy may remain resilient. Recent investor surveys showed strong optimism and low hedging, meaning many expect continued growth or no landing scenario. Some analysts believe that consumer spending and fiscal stimulus could help prevent a recession next year. Summary: a recession might occur in 2026 or late 2027, but most forecasts show slow growth rather than guaranteed contraction. Economies are fragile due to factors like tariffs, inflation, and concentrated growth drivers, for example tech/AI sectors, but not definitively in recession yet. 2. Key signals and risks in the global economy. A. Slowing growth and heavy reliance on tech. Global expansion continues, but economists highlight that much of the recent growth is concentrated in a small group of sectors, especially technology and AI. If these falter, the broader economy could slow sharply. B. Trade and policy uncertainty. Recent geopolitical tensions and trade tariff threats can hurt consumer spending, reduce confidence, and slow business investment. These shocks aren't always direct recession triggers, but they increase uncertainty and volatility. C. Banking sector conditions. 2026 could be pivotal for banks, with slow growth, unchanged margins, and economic headwinds potentially testing financial resilience. D. Consumer confidence and labor. Market employment strength and consumer spending remain major recession buffers. If unemployment rises significantly, it could weaken spending and push economies into contraction. 3. How does this compare to the 2008 crisis? Short answer: this risk environment is different and not clearly worse than 2008, but still serious. A. 2008 was a financial system collapse. The 2008 global financial crisis was triggered by massive mortgage defaults, financial institution failures, credit contraction, and systemic risk spreading through banks and markets. It involved housing bubble bursting, Lehman Brothers collapse, global credit freeze. This made 2008 unusually deep and severe. B. Current differences in 2026 outlook. Today's economy, while slower in growth, is not exhibiting the same structural financial fragility. No systemic banking collapse yet, no massive mortgage defaults. Banks now have stronger capital requirements, and central banks have more tools to respond than in 2008. C. Different risks. Instead of banking collapse, the current risks are slower growth and inflation persistence, concentrated industry reliance, tech/AI, trade tensions, debt levels, and fiscal policy uncertainty. These can cause market corrections, volatility, and slower corporate earnings, but not necessarily a crisis as deep as 2008. The 2008 crisis was structural failure in the financial system. This environment is different, with less evidence of collapse, but more fragility around growth, geopolitics, and concentrated sectors. 4. What happens in a recession? What to expect. Even if a full recession does not arrive, slower growth or volatility can affect A. Employment. Job growth may slow and layoffs can rise, reducing income and spending. B. Markets. Stocks often fall. Sectors correlated with discretionary spending, retail, travel, may weaken. C. Credit tightening can occur. Lenders become more conservative about loans. D. Businesses. Corporate profits may shrink, investments slow, and some companies fail. 5. How to save and protect your assets in a recession. If recession risk increases, protecting wealth becomes critical. Below are strategies used by financial planners and investors. A. Build or strengthen your emergency fund. Goal: 6 to 12 months of living expenses in cash or liquid savings. Why? During recessions, income can drop and credit can tighten. A strong cash cushion prevents forced selling of investments at low prices. B. Reduce high-interest debt. Pay off or reduce credit card debt, personal loans, high-interest borrowings. High interest erodes financial security, especially if income falls in a downturn. C. Diversify investments. Avoid concentration in one asset class or sector. Diversification approaches. Stocks plus bonds mix. Equity is usually more volatile. Bonds can offer stability. Geographic diversification. International exposure. Asset classes. Real estate, commodities, defensive sectors. Lower correlation assets. For example, some commodities like gold may act as a hedge. Diversification does not eliminate risk, but can reduce volatility. D. Shift focus to quality investments. In uncertain times, investors often prioritize companies with strong cash flow, low debt balance sheets, predictable earnings, essential services/products. High-quality firms tend to weather recessions better. E. Consider defensive asset classes. Defensive investments can include high-quality government bonds. Dividend-paying stocks tend to be less volatile. Precious metals like gold, often seen as a store of value in uncertain markets. These can cushion portfolio declines. F. Maintain a long-term perspective. Recessions are part of economic cycles. Selling during downturns can lock in losses. Long-term investors often avoid panic selling. Rebalance portfolios periodically. Take advantage of lower prices to invest gradually. Dollar cost averaging. G. Protect your career/earnings. Economic downturns often affect employment before financial markets. Strategies. Upgrade skills relevant to stable or high-demand sectors. Maintain a network. Build multiple income streams if possible. This strengthens financial resilience beyond investment alone. H. Reduce unnecessary expenses. Lowering fixed costs increases your financial flexibility in volatile times. Avoiding luxury purchases or high-leverage commitments during uncertain economic periods can prevent financial stress. 6. Should you panic? Perspective. Important. A recession risk is not a certainty. Many indicators point to slow growth rather than full contraction. Most economists forecast continued expansion, albeit slower, rather than a repeat of 2008's financial meltdown. Investors wrong about recessions are common. Economists and markets do not always agree. And surveys often show the public expects downturns, even when data is mixed. History shows that markets and economies fluctuate. Downturns are normal, and they are often followed by recoveries.